Hey, what's going on, you guys? Josh back with another video for the Tech Budge Group. Hope you guys are having a great day so far. And today I want to talk about the ABCD pattern, right? Today I want to talk strategy. I'm sure you guys have seen plenty and plenty of videos talking about, risk management and 2-to-1 risk reward and, how to identify support and resistance on the daily chart and the intraday chart. But today I want to talk about the actual thing that makes you money, which is a surefire strategy that's very, very easy to identify, right? And it has a high odds setup. So whenever you have these patterns that present themselves, you want to be able to play patterns that can be easy to identify, have a high odds setup, and have a great profit margin. So with that being said, I want to start from the top and work our way down and kind of dissect the ABCD pattern. And to start that, we're going to talk about the pattern as a whole, right? Now, this pattern has four main components to it. We have the A, the B, the C, and the D. Now, for A, that might be a morning spike. That might be a big push up, in the afternoon, whatever the case might be. But A is going to be your first big run up, right? Whatever that kind of run might be. Maybe it's a run on good earnings. Maybe it's a morning spike. Maybe it has a small dip. Then it bounces up again. It has another spike. Whatever the case might be, you're going to have a big impulse, which is going to be your A. And that's going to be the top of that run. So wherever it tops out at, that's going to be marked up as your A point. And when it comes back down to consolidate, wherever it bases out at, that's going to be your B point. Then we have another big perk up. We have another big pullback. And wherever that second higher low comes down to, that's going to be your C point. And whenever you see that higher low confirm, you want to take your entry on that higher low at C and risk off of B, right? So you already have your risk determined at B. Now your profit area is going to be D. So the stock's going to come up, come down, come up, create a higher low. That means the stock is on a bullish uptrend, and you're going to anticipate that breakout from the previous high at A and look to take your profits into that push past A up to the D area. So with that being said, you might be saying, well, Josh, why don't you buy at B, right? Why don't you, get that big impulse, comes back down, and when it bases out, why don't you buy the stock at B? Well, what's going to happen is you're going to come back up, and you're going to create a higher low, right? And then also a higher high. A lower high, I'm sorry. So what that means is you have a conflict of interest. When the stock comes down and bottoms and creates a higher low, that symbols a bullish momentum. And then when it comes up and it creates a lower high, that symbols a bearish momentum. So with that being said, it's hard to determine which way it's going to go. This stock could very easily come back down and start to fall apart. And if that's the case, you don't want to be taking a long position on that kind of stock. But when the stock comes back down a second time and creates a higher low, that lets you know that the stock is going to be in a bullish momentum, and that's where you can take your entry. And with that being said, you also have that risk level down to B, and you know you're risking to. So with that being said, what we're going to do is we're going to jump into some charts here, and I'm going to further break this this pattern down for you. So right now we're looking at LINU, and LINU has a perfect ABCD pattern setup here. If you take a look here, and I'll kind of draw this out for you, the ABCD pattern starts like this. We have a big move upwards, right? This is going to be our A. Then when it comes down to consolidate, that's going to be our B. Now we have another bounce up. We come back down, and it's clear as day, we have another higher low, which is going to be our C. Now at this point, this is where you're looking to take your entry, right? When it starts to perk back up, you're getting in between, $2 and let's say $2.10 when you see it start to perk up again, and you're risking down to 180, right? Where the previous low came down to. And then we're looking for our profit in D, right? And you can see clear as day, comes up A, comes down B, bounces and comes back, creates a higher low, which is your C, and you're anticipating that break of the previous high at 230, looking for that push up, maybe 40, 50, 60 cents of profit. In this case, you actually get that. So you're risking 20 cents down to 180. You're looking for a 40-cent profit move, right? So let's say you get in at $2, 20 cents up to the high of day, 40 cents on the big rip up. And if you want to keep holding it, you can even see that 60 to 80-cent profit on this stock. As a matter of fact, you might even get a $1 move on this if you're able to hold that long. So with that being said, that's how the ABC pattern looks on this chart. Let's check out another one real quick. Let's take a look at SNCR. Now SNCR has a beautiful, beautiful ABCD pattern here. And I'm going to go ahead and start from the beginning, remove some of this stuff. If we zoom in a little bit here, right, we can take a look at this. So the ABCD pattern looks different on every single chart, but it's basically the same concept no matter where you go. You get a nice morning move up here to $14. We come back down and we start to base out at around $13.40, so that's your B. We come back up, perk up, come back down, higher low at around 160, 150 area, let's say like around 150. There's your higher low. That's your entry point. So between 150 and 160, you can take your entry. Let's say, for example, you take your entry at 160. At 1360, I'm sorry, and you're risking down to 1340, so a 20-cent risk and 2-to-1 risk reward. You're looking for that 40 cent of profit. So start to perk up 10 cents, 20 cents, 30 cents, 40 cents is the high a day. So even if it doesn't break the high a day, you're already in the green. You already have a perfect trade right here because you have that 2-to-1 risk reward as it is. Now in this case, we do break the high a day, right? So 50 cents, 60, 70, 80 cents of profit on the upside, and you're only risking 20 cents on the downside. So with that being said, you have a perfect 2-to-1 risk reward, a potential 3-to-1, and potentially even 4-to-1, depending on how far this thing could have gone, you could have taken your profits on. So it's a perfect pattern to play. It's easy to identify. And when you see it, right, when you get used to seeing this pattern, you can easily identify it and you can take your position knowing that a majority of the time this this pattern is going to play out for you. Let's take another look here. AHIC, right? This one's a little bit different, right? And the reason for that is because it doesn't, it actually breaks the high a day on the pattern. So it's not like it comes up and it perks up just below the high a day and it creates a higher low. We actually move up and break the high a day, and then we get another higher low here. And as a matter of fact, if you want to be a little bit more specific and a little bit more precise on your entry, we do have a perfect ABCD pattern here before we break the high a day. So I'll show you both of those. We're going to move up, comes back down. So here's your A, here's your B, and you can use this as your C, which is actually a perfect entry, risking down to 160. You get in at 1070, risk down to 1060, anticipating that break of 1090. You're looking for that push of $11, maybe 11.20, however far this bad boy runs. So we come up, there's your A, there's your B. It bounces a little bit, pulls back, base is at 170, there's your C. You take your entry at 170, risking down to, I'm sorry, I keep saying 170. You take your entry at 1070, risking down to 1060, anticipating that break of the high a day at 1090, looking to get up, to $12, $11, maybe, 11.20, whatever the case might be. So with that being said, you have a 10-cent risk, looking for 20, 30, 40 cents of profit, and in that case, you get it, right? So pretty easy, pretty simple, no big deal to it. In a lot of cases, like this one you see here, it's kind of hard to identify that next higher low. You might have some trouble identifying that. But with a case like that, what you can do is anticipate the grinding action. Because a lot of times these stock will start to grind up. We come up, we come down, and we kind of start to grind. We grind, and then boom, we break the high a day, and then we have this nice big move up to 11.30, and then we actually pull back again. So with that being said, a lot of times what will happen is you'll get that break a high a day, and as you keep moving up, what you can actually do is adjust your risk. So your risk was down here, right? But once you break the high a day, what you can actually do is move your risk from that low, from the B area. You can actually adjust your risk and use the high a day as your new risk point. And in this case, it would have worked out perfectly. You would have came up, you would have got in around here, right? You would have got it on that next higher low, risking off the high a day. Once you break the high a day and you come back up, you want to move your risk up to the high a day in that situation and be like, okay, well, I already have some of the house's money from my good entry down at 1070. And now that we're breaking past 1090, that's already my 2-to-1 risk reward right there. I made 20 cents risking 10 cents, perfect. And in this situation, the stock just takes off. So what I'm going to do is I'm going to move my risk up from B, which is 1060, and I'm going to move it up to the high a day at 1090. And if the stock breaks past 1090, I'm going to take my shares out for that 2-to-1 risk reward profit. If not, then I'm going to let the chart play out a little bit. I'm going to let the chart develop, and then depending on, how far I move my risk up, if it breaks that next risk area, then I'll take my shares out for a profit. So we break 1090, we move up, move up, move up. We come back down, get close to 1090, but we actually hold at 11. So guess what? My risk goes from 1090 up to 11. Now we perk up, perk up, perk up. We have another pullback, right? Down to around 1140 over and under. So that's my new risk, 1140 over and under. We come up, come back down, test 1140 again, and then we perk back up to 1185. So from where you got in at 1070, you're already up $1 a share on this position, right? If you had 1,000 shares, you had a $10,000 position, that's $1,000 of profit right there. You had 100 shares, right? On this position, that's $100 of profit, right? So this is a perfect example of that ABCD pattern. You come up, come down, you bounce, you get that higher low, then you get the break of the high a day, right? You come back down to test that high a day area. You hold that area as support now, as opposed to being resistance earlier. As we know, old resistance becomes new support on bullish stocks. So it keeps going up, keeps going up, keeps going up, and then you take your profits out, right? Because once you're in the house's money like this, you can be more patient. You can let the chart work out for you. And a lot of times, these charts just keep on running, and they never look back. So that's another example of the ABCD pattern. We're going to look at one more here, RYTM. And this is a perfect ABCD pattern as well because, if you're patient, if you let the chart play out, again, you can see those huge gains throughout the day. So we're going to zoom in here a little bit, right? And we see the ABCD pattern set up pretty nicely here. We have this move up in the morning. There's your A, right? We come back down. We start to base out. There's your B. We bounce again, come back down, and we set a higher low. There's your C. This is where you take your entry. Anywhere between here, risking off the bottom, which I would say probably, 25.50 would be your risk area. And then we start to perk up. We start to grind up towards that high a day. And then when we break the high a day here, right, you have one or two choices, right? You can either take your profits, which a lot of traders do, or you can see what happens. Because in this situation, the high a day starts to grind out a little bit here, right? It starts to struggle. We break it, but we come back under it, over, under. And that's why I always say, when you base your risk, you want to base your risk off the area that, holds over and under. So in this situation, $26 holds over and under as support. We come back up, $26 holds over as support. So now it's a pretty clear defined area as support, as opposed to here where it kind of chops around a little bit between $26 and $25.50. So now you have a clear higher low and a clear support at $26. As we perk up and we break past the high a day, you let it chop around a little bit because you're already in the house's money, right? Remember that. You're already in the house's money, so you can be patient and let the chart play out in your favor. And then once we start to perk up and we come back down and we confirm the high a day at $28 as the new support, guess what? Your risk level moves up from $25.50 up to the high a day at $28. So now you can let the chart play out. And once that happens, we never look back, right? We start perking up, we keep grinding up. And all of a sudden, towards the end of the day, you got in at, $26.30. And towards the end of the day, we perk all the way up to $33.81. That's a $7 move. That's a 7-point move from where you got in at, right? If you let the chart play out. If you had 1,000 shares, that's $7,000 of profit in one day and one chart, right? You don't have to take 5, 6, 7, 8 trades on this, especially if you're under the PDT rule. If you can anticipate this move, all you need is one good chart, and you can make seven times your position size. 1,000 shares, that's $7,000. 100 shares, you take a $2,600 position on this, you're up $700 towards the end of the day, right? I mean, that's amazing. That's an amazing return because you're only risking, $26.30 down to, let's say, $25.50. You're only risking like 80 cents a share. So you're risking almost $1, give or take, with the potential to make $7 in profit. That's absolutely insane. So with that being said, that's the ABCD pattern, guys. Pretty simple, pretty easy to understand. One more thing I want to show you guys is whenever you're looking at these ABCD patterns, what you want to do is draw a trend line. So if you see at the bottom of B here, if I draw a trend line straight up through B, through C, and anticipating that break of D, as you see, it kind of bounces off that trend line as it comes up. Comes down bases, higher low, and then we get that break, right? And if we go to any other chart, it's the same thing. Let me show you guys real quick as well. SNCR, let's just do that one. Right? We come back over here. We have our high a day, right? Pretty simple. And then we have this trend line. And as that trend line gets closer and closer, we start to get some resolve in this area. As these lines get closer and closer, there goes your opportunity to take profit. So once you start drawing that triangle, and that triangle is able to hold these higher lows every single time, right? You get a bounce, higher low off that triangle, off that line upwards, off that trend line, right? And then in this case, sometimes you get another bounce and a couple more bounces, but in this case, the stock was very strong, and we went straight up, and we just, shattered that high a day at $14, and we never really looked back. We just went straight up to $14.40, and then we had a pullback. But by then, you're already locking in profits, right? So another thing to understand with the ABCD pattern is that you want to be locking in profits when everybody else is buying. So what you see right here, when everybody else is pushing this stock up, when they're buying it because of the high a day break, you're selling. You're looking to take your position off into this move upwards, right? So you're able to get in early because you're able to identify this pattern. And then when everybody else sees this high a day break and they're like, oh my God, the stock is about to break out, let's buy it. And everybody's buying it up. And you get this surge in volume down here, and everybody's buying and buying and buying. Guess what? You're selling. You're selling into this push. You have all this liquidity to sell into. And then at the top here, when everybody else freaks out and they start selling and they start dumping their shares, you're out of the trade. You're sitting back with your Kool-Aid or your grapes or whatever the case might be, and you're enjoying the profits that you just took on this trade because you're able to anticipate it beforehand. So thanks for watching, guys. Pretty simple pattern. If you have any questions, I'd love to talk to you more about it in the comments below. Go ahead and follow us on the TechBuds Facebook page. We're a free trading group. It allows a lot of the newer traders to learn and understand what goes into trading and what it means to be a day trader or a swing trader. So if you're interested in joining that free group, go in and join us on the TechBud Solutions Facebook page. I'll have all that information in the description below for you guys. But without further ado, thanks for watching, guys, and I'll see you on the next video.